get more on the anticipation surrounding that inflation figure. 2% at the moment. Victoria's here from our business unit. It's important, this, because, well, there are lots of worries if it goes down, and indeed if it goes up.
Absolutely. What we're expecting, in fact, is we might actually see a slight fall. At the moment, it's at 2%. That's the Bank of England target rate, so looking good. But we might actually see it come down a little bit today because retailers were discounting very heavily over the period. That's sort of December, January, and the Christmas and aftermath. We also see things like fuel prices that have so often really raised prices. We've seen all those stories in the past of all the petrol pump prices going up. They've actually been quite steady. And we've also seen the energy companies, in some cases, lowering their energy price rises that they were planning on doing. That's what we're expecting. Perhaps 2%, perhaps a little bit lower. Apparently, it's 9:30, so we can go to the ONS. Let's speak now to Phil Gooding. Phil, can you bring us the numbers, please?
Yes, good morning. The Consumer Prices Index grew by 1.9%, as you were just predicting, so that's slightly down from the 2.0% for December. What we've seen over the last 4 months is the rate is at or around the government's inflation target. And as you just mentioned, it's actually below target now for the first time since November 2009. OK,
so if you could tell us what that actually means for a basket of shopping, a basket of shopping that cost you maybe £100 in January 2013, what does that mean for now?
OK, a basket of goods that cost about £100 in January 2012 would cost £101.90 in January 2013.
OK, and what were the main contributors?
OK, well, the headline rate didn't actually change by that much, and the factors behind it also didn't change terribly much. The main downward effects behind the change in the rate came from 3 main areas: recreation and culture, furniture and household goods, and alcohol and tobacco. In the case of recreation and culture, we saw prices fall between December and January by slightly more than they did between the same 2 months a year earlier. The effect there came from a combination of recording media, so items such as DVDs, and also from recreational and cultural services. So there we're talking about admissions to attractions and cultural events. With furniture and household goods, prices normally fall into January due to the January sales, but this year they fell by a little bit more than they did a year ago, with the main downward effect coming from furniture. And then finally, with alcohol and tobacco, prices usually rise after Christmas, but this year they didn't rise by as much as they did a year ago, and the downward effect here came mainly from spirits, particularly whiskey. So the main downward effects then coming from 3 areas: recreation and culture, furniture and household goods, and alcohol and tobacco.
Overall, though, food and drink prices, excluding alcohol, they've often outstripped overall inflation, haven't they, for many years?
That's right. We had a slight upward effect from food and soft drinks this month. Prices rose by 0.2% between December and January, compared with 0.1% a year earlier. The upward effects here came from a combination of sugar, jam, confectionery and chocolate, and also from fruit.
Phil Gooding, thank you very much from the ONS. So inflation at 1.9%, that still means we do have a squeeze on households, because the latest indicator on pay packets, if you exclude bonuses, was the earnings are rising at 1.3%. Let's go to the city now and speak to Michael Hewson. Michael, what's your reaction to the numbers?
Yeah, good morning, Victoria. Pretty much as expected, 1.9. There was an expectation that we would see that, and it was largely driven by shop prices. The British Retail Consortium shown that shop prices have dropped for 2 months in a row, 0.8 in December, 1% in January. And I think that really does explain the very good retail sales figure number that we saw in December, that massive 2.6% jump, which really was jaw-droppingly high. Unfortunately, I think we could actually get, at the end of this week, a little bit of an adjustment on that, because I think what people did last month was they brought forward their spending for January.
What are the risks then to inflation in the medium term?
I think in the medium term, risks are obviously a slowdown in growth here in the UK. I don't think we should underestimate the risks that the floods could have to economic growth in the first half of this year. Having said that, reconstruction work in the second part of the year could provide a bounce back. I also think there is possibly a potential deflationary threat from falling prices, not only in Europe but in the global economy as a whole. Obviously there is a concern about oil prices, geopolitical risk there. Brent prices have pretty much gone nowhere over the past 3 to 4 months, but offsetting that, I think, has been the rise in the pound over the past 9 to 12 months. If we look back to about a year ago, CPI was around about 2.8%. The pound was at 148 against the dollar. Given that commodity prices are largely priced in dollars, the rise in the pound over the past 12 months has actually mitigated an awful lot of that upside inflation risk.
Right, Michael Hewson from the City, thank you very much for that. So, British inflation falling to 1.9%, the lowest since November 2009, and that really indicates and gives the Bank of England a lot of remit really to keep those interest rates low for at least the medium term. Here's the graph of inflation. I can see it coming up now. There we go. So 1.9%. You can see how it's fallen over the last couple of years. So really a downward trend, and now below that 2% Bank of England target rate.
Victoria, thank you very much. Well done.
I dropped a bit, sorry. I'll sort myself out. Thank you very much.
Thank you, Victoria.
More reaction to that, of course, later on.